On this day, we interviewed Randy Smith. He's a investor out of Arizona, the state of Arizona, the entire state. He's doing capital raising. He got into real estate with some turnkey single family homes.
He explains what turnkey is and says how they were not.
Yeah. So that led him to pursue something else in real estate, which led to syndications and then now being a capital raiser. So that's primarily what he's doing, which is interesting. And it's always cool hearing about all the different ways you can invest in real estate without actually having to turn keys.
All right. Welcome to another episode of the Investing RN. Today we have Randy Smith doing a lot of investments, passive investment, capital raising, a lot of really cool stuff. I met him through, I know I've mentioned GoBundance on this podcast a few times, so that's how we met. We connected through that, and looking forward to diving in and learning a lot from him today. Randy, thanks for coming on.
Awesome. Thanks so much, Joshua, Colin, for having me on the show. Excited to hopefully share something that the audience gets some value from and certainly learn more about you guys. So it'll be fun.
Yeah, for sure. Yeah. So start with your background. Like, what do you do? What's your day job? What does that look like? The past you, and then we'll go into your current you.
Past and current. Okay. So 25-year sales guy in corporate America in various Fortune 100, Fortune 200 companies. Most recently in a financial services company, credit card company, actually. Big Blue, or the Blue Box, you might be familiar with. You don't want to leave home without it. I'll just say that. And yeah, so I was a sales guy for 25 years and got into the real estate investing space probably 6 years ago, buying single family out of state, like so many people do when they first get started, and found pretty quickly that was not going to be my path to financial freedom. So I started investing passively. And as luck would have it, after a couple of years doing so, I got laid off from corporate America. And fortunately, the majority of my monthly expenses were covered from my passive income. So I got to cut the string and tie to corporate America and hope to never go back. Now I'm a full-time entrepreneur, capital raiser, syndicator, all things real estate investing.
I think so. One of the things I think for me being in LA is, we did out of state investing as well. Well, out of state for me, in state for Josh, because we were buying our properties in Wisconsin.
Okay.
But what market did you start in, and how did you decide on that?
Yeah, so it's kind of embarrassing to say, but I had been sitting on the sideline for a number of years listening to podcasts and reading books, and heard so many different opportunities come up. And finally, I was listening to a podcast, the Real Estate Guys radio show, and I heard a turnkey single family operator that was based out of Kansas City. And he was a very energetic and enthusiastic promoter, and made the decision that this is it, honey, we're jumping in and this is what we're doing. And we ended up buying a couple of Kansas City turnkey rentals that I could write a book about all of the challenges that we had with those turnkeys, because they were anything but turnkey. So there was not a lot of methodology behind why I chose Kansas City. It was more matter of chance that this guy happened to be doing it in Kansas City. So
I've heard that actually quite often. Like, a lot of these turnkey companies are anything but turnkeys. Like, what does that actually mean? Like, who knows? Like, it's been renovated maybe, or like, what did your first turnkey look like?
Yeah. So these were call them $100,000 assets. And the definition of turnkey is that you're supposed to be able to buy it turnkey, and all of a sudden you start getting mailbox money. And, it was presented as if he was essentially doing burrs for you. So he would buy an ugly house, renovate it, get a renter in it, and then hand it over to you. And then he had a property manager as well, or a property management company. So he would handle everything for you. What it looked like in application for me was I wired the funds, got the financing. He handed over the keys of an asset that he had been sitting on for a few months that already had a bad tenant in it. And about 3 weeks into it, I got an $8,000 bill for a new roof. I got a $4,000 bill for a plumbing issue like 30 days later. We just had all kinds of issues, like one thing after the other for 6 months. And I didn't just buy one. It was so much fun. I decided to buy two right away because I'm a ready, fire, aim type of guy, as they say. And yeah, it was a heck of a ride, but learned a lot. And honestly, I don't know that I'd be where I am today had I not taken that first leap. And real estate is very, very forgiving. So I made quite a bit of money on those when I sold them in 2022 as well. So even with all the issues, was able to make some money on it.
Were there any red flags in your mind going into that? Or you said he was very energetic, very motivational, it sounds like. Because I would imagine my thought process would be, if they're turnkey and so easy, why don't you just keep them yourself and own 100% of them? Like, why would he even sell them and then manage them?
Yeah. The thought didn't even enter my mind, Joshua. In hindsight, I wish it would have. But I think I was a gullible guy who wanted to get into the space. And, being a sales guys quite often have, they have a hard time with other salespeople as well. So either they just lay down and buy anything from them, or they won't buy anything because, just salespeople tend to be a little more skeptical of other salespeople. Where I probably made my biggest mistake, or probably two big mistakes, were one, I assumed that since this guy was on a national podcast that had a very large brand, I assumed, and I say that it was my assumption, it was never portrayed that way by the podcast, but I assumed that they had been vetted and they were high quality operators because they were on this large platform. So that was my first big mistake. My second big mistake, and probably the bigger of the two, was that in any type of acquisition in real estate, you need to have where people come in and they review the asset and they'll give you a report of all the things that are wrong. And inspection. Yeah. So he offered to connect me with an inspector, or he offered for me to just review his personal in-house inspection that he did. And I fell for the latter and said, well, I'll just review yours. And of course there was no, there wasn't a third party inspector there. So he shared with me exactly what he wanted to share with me. And I just took it as fact and went from there. So any external inspector would have seen that, the roof was bad. The grading on the side of the house was bad. A review of the lease would have shown very, very quickly that this was a terrible lease they had in place, and it was a bad tenant with bad credit and bad pay history. But, I took it on his word that this was a good asset and good renter, and it turned out not to be. So
I think, like, even with that inspection piece, it's like, so we've made several mistakes around inspections in our history, but there was actually one property we bought that we got an inspection on, and like there was a decent amount of stuff that came up on the inspection. But then I think it was like a year or so later, year and a half, 2 years later, market change, we decided to sell the property, and the buyer got an inspection, and it was like robo inspector. Like, this guy went in and found like everything, and we're like, I mean, like, as far as we knew, we had done everything right because we got an inspection, but like, I guess the point is like, not all inspectors and inspections are created equal. So
absolutely.
After kind of learning the lesson you learned, which was kind of different, like, what did you do going forward? Did you just say, like, I'm done with single family and move on, or did you have some way of like some process for like sorting that out?
Yeah, so I took a little bit of a step back with that, and I found out pretty quickly that I wanted to be more in control of the renovation, the asset selection process, the team selection process. So we even went one step further back, and we started to do some research on what the best markets were to invest in, and we ended up finding Atlanta as a hot market that was up and coming. There were certain areas of Atlanta that could be really advantageous from a BRRRR strategy standpoint, and we found some realtors out there, and we found some property managers and construction groups, and we really we wanted to take back the control that we had given to the turnkey guy, and do that ourselves. And we ended up having a lot of success doing the BRRRR strategy in Atlanta, and our timing was impeccable because the market was exploding, and we made quite a bit of capital, quite a bit of return on 3 or 4 assets that we bought out there in a relatively short amount of time. So it was a lot of fun. There were a lot of challenges and heartaches and funny stories that come along with the Burr strategy as well. But we got to have get our hands a little dirty. We flew out there and felt like we were truly real estate investors doing the work that real estate investors do. So that was a better experience. But as we got into it, the market shifted, and we didn't see that we could scale that as fast as we wanted to. So that's when I started looking at syndications and multifamily and mobile home parks and things as such. So
yeah, mobile home parks, that's what we do. So
yeah,
we'll talk about that in a little bit. But okay, so you mentioned you were in corporate sales and all that, and then you were laid off. At what point in your investing career did you get laid off, and how did that change the way you do things?
Yeah, good question. So, and it's maybe to back up just a little bit. I mentioned I was in corporate America for 20 years. I worked the last 20 years of my career in 2 different companies, 10 years each. I got laid off after 10 years with first corporate America job. And at the time, I had not done any real estate investing at all. And I had made decent money, so we were doing well financially, but I was very, very strongly dependent on that W-2, like so many are. So I got a severance package, and as the severance started to wear off, it starts getting scarier and scarier, and you start kind of changing the type of jobs you're looking for because you're starting to get desperate. Fortunately, I landed at an amazing organization and had another 10-year career that went really, really well. But about halfway through that is when I got into real estate investing. And, in the back of my mind, I always knew that layoffs were inevitable if you're in corporate America. So by the time, the 5 years passed between starting there and starting in real estate and then another 5 years, it was an entirely different type of situation when I got laid off the second time. And all of a sudden I had options because of my real estate investing that I didn't have before. And that's what I'm doing now, is trying to teach people how to have those same types of options in their W-2. So when and if that comes where they get laid off, they don't have to jump in and get desperate and take a job that they don't want to take. They have more options, just like my family and I did. So.
Yeah, I think that's kind of us targeting nurses. That's in our case, it's not so much layoffs, but it's like nurse burnout. Just tough field to work in. There's a lot of stuff going on, especially over the last several years.
Of course.
And it's that options thing. Like that's a big thing we're kind of, I don't want to say preaching, but like the message we're trying to get out there is just like set yourself up with options, because you never know what's going to happen, and it could be a health thing, it could be a layoff or whatever. But like, yeah, it's that money starts running out, it gets scary. So yeah, if you have those options in place, you're a lot more powerful. And some people might still want to keep doing whatever they're doing, but it just takes that pressure off needing to
Absolutely.
do it. Yeah. So
you take anybody as an RN or a doctor or sales guy, whatever it is, if they're making $7,000 to $10,000 a month in real estate investing, it really takes the pressure off of the 9 to 5. You can do anything you want at that point, ultimately.
Yeah. Yeah. And so you said from there you got into syndications. So can you kind of, that's come up on the show a couple times, and each time I think it's worth explaining, just because it's kind of such a big process.
Yeah. So the basic syndication model is kind of essentially you have operators that get started, and usually they're funding their own deals when they first get started. Maybe they've got close friends and family that are putting dollars in those. But as they get more successful in the space, they generally move towards doing bigger and bigger opportunities. And as you do bigger opportunities, you need to come to the table with more capital. And it doesn't matter how much money you have or how much money you make. At some point, you're going to run out of capital, and you need to start partnering with other people to bring those dollars to the table. So a syndication is basically really any type of operating entity that is trying to grow and trying to buy bigger assets and needs external capital to do so. So the operator will reach out to their investors or promote their whatever offering they have, and the passive investor comes to sit in alongside on these operations, and they get to peek behind the curtains and see how the operations are being worked. And then when they sell the assets on the back end and even throughout the hold, they get to share on the upside. So true passive investor can focus on what they do best, which is earning money probably in their W-2. And then they get to share in all of the benefits of owning real estate by partnering with, first class, world class operators that are going to be good stewards of the dollars. So it's really the best of both worlds for the actively employed that are trying to get, their feet wet in the real estate space.
So I guess to kind of go back to your story about how you got into the real estate with the guy that ended up being what sounds like a fraud. Like
yeah.
How do you how would you what advice would you give to people who are new to this game in picking a syndication or a company to invest with so that they don't end up in a similar situation with, I don't know. I mean, I don't know how much money you had invested in the first deal, but I know some of these syndications, it's $50,000-$100,000.
Sure. Yeah, I think that's probably the single most important question a passive investor should be asking is how do you vet the operator and vet the deal? And anybody can go out on Google and say, top 100 questions to ask a syndication or an operator. And actually, I would encourage folks to do that because that's a really good way to understand what types of things you should be looking at. But I think at the end of the day, it's an interview process. So you got to get to know that individual or that operator or that group or organization and understand what they've done in the past and understand that if they've gotten very skilled and have gained the expertise in a certain type of business model in a certain area, then it's likely that they're going to be able to duplicate that moving forward. So spending a lot of time looking at track record, I think, is extremely important. I think also, though, you run into a lot of folks that are just getting started in this space. And I think it would be unfair to say, don't ever invest with somebody unless they've got 10 years of experience in the space. Because like you guys are experts in what you do, both in the in your medical professions. So that track record that you've created in other roles up to this point, I think translates and transfers into the operations of your business. So what do they say? Like, eagles soar with eagles, and once an eagle, always an eagle. So, if you've been a stud in prior roles, you're probably a stud in everything that you do because how you do anything is how you do everything generally. So I think looking at track record is first and foremost. And then as you get more skilled, like you really start to look at the nuances in underwriting and the due diligence process and the assumptions that go into the underwriting models. Like it can go on and on and on. But at the end of the day, you've just got to build a level of trust and comfort with an operator. And then odds are the deals that they'll put in front of you will all look very similar. And the due diligence requirements decrease each time you invest with them because you like and trust them and you've got history and experience with them.
So I love that perspective. So a couple of weeks ago, I went on Jason Trees. I was on his podcast, and there's always a little bit of imposter syndrome with everybody at some point. And like that's something that in the past I've struggled with because I feel like I'm an expert inside the hospital at what I do, but then we come over here to real estate investing. And do I feel like an expert? No, not really. Am I really good at it? Also, I don't know. No.
Yeah.
No, but with what we've been able to build, I think a lot of people would say that we're probably pretty decent at what we're doing.
Absolutely.
But I guess to your point, it kind of translates. Like we're experts inside the hospital. It does translate when you start to dive into other things, and we're not afraid to ask for help whenever we need it. That's another point.
Absolutely. Yeah. And probably as an expert, you also know what you don't know. So then you can lean on people that are experts in those areas, right? It's not just Joshua and Colin who your investors are working with. It's the team and the network and the expertise that back you up all the way. So yeah, that's a good point.
Yeah. So what is your role right now? Are you working with a certain company where you do syndications as a group, or I think you said you were a fund manager now? What exactly does that mean?
Yeah, so I had invested very heavily with an operator here in Phoenix, Arizona, in the multifamily value add space, and being a sales guy, scream it from the mountaintop type of guy. When I am excited about something, I tell everybody I know, and if you're standing, still for any amount of time next to me, you're going to hear what it is that I'm doing. So ultimately, what happened because of that is I ended up referring a number of investors to the operator that I had invested with here in Phoenix. And it was not insignificant. We're talking, almost $1 million worth of investor capital that I referred over to this operator. So when I got laid off, I connected with everybody that I knew in the space. I actually was part of the Jason Drees coaching community at the time as
Oh,
well.
nice.
And, talked with a coach there and at a couple of conferences and met everybody that I knew. And I ended up talking with this operator and shared what was going on. And he said, clearly your skill set aligns very well with investor relations, communications, marketing, sales. Why don't you try bringing investor capital to one of our opportunities in the future? So I launched my company, Impact Equity, with a personally made website and terrible brand image and all of that other stuff, and essentially just leveraged my network. And I raised almost $1 million using a fund to fund structure for this operator. And that took, less than 30 days to do so. And there was a very large appetite for capital at the time. So it made sense just to go deeper and continue going down that path. And, fast forward, almost 2 years now, and we've raised, $7 million myself personally, and I brought a couple million more from other partners that I've worked with, and we've done 12 or 13 projects. So we are kind of a hot commodity from other syndicators and folks that are trying to raise capital. And it's just a lot of fun. I spend the majority of my day educating newer passive investors, and now getting to deal with the joys of growing what is becoming a larger and larger business at this point. So
that's great. So you pull a bunch of money together. I guess a question I have for you is, so last year I sold one of my houses and made a pretty decent chunk of money, and I was anxious to redeploy it. Yeah. So what is your strategy? Because you're pulling all this money together. As soon as you get this money, are you looking for somewhere to deploy it as fast as you can, or are you waiting for the right opportunity? And what does that look like?
Yeah, really good question. So I think people place capital very quickly for a lot of the wrong reasons. And I think that's a really good way to get average or bad returns for your money. So I sit on the sidelines and I might see 30 or 40 deals a month that come across my desk. And I might see 8 or 10 operators that are looking for partners to raise capital for them. So I have my own vetting process, both on operators and on deals. And I sit back and wait until I see a deal that I like. And when I do see one, I being a fund manager, I actually set up an individual fund for every opportunity that I do. And I will commit as a fund to X amount of dollars to each project that I work on. And generally we have 30 to 45 days to go and get the capital from our investors to place it. But I personally don't believe in the blind pool fund, especially for somebody with the experience that I have. I think 5 to 7 to 10 years down the road, I might be able to do a blind fund pool, but I don't have the track record or the experience today. So I leverage my partners' history and experience and credibility. And then I go out to my investors and say, we're bringing dollars to this deal. This is their track record. This is what they've done in the past. Do you want to come on board and get better returns through me? Because I'm bringing a bigger check, and that gives me the ability to negotiate better terms. So as a fund manager, I can really pick and choose where I place the capital, but I always have the asset identified before I start talking to my investors about it.
Okay, I think that answers my question, because I was imagining you just have all the money already and you're just sitting with it, waiting for something to show up on your desk. But it sounds like you're looking for deals, and then when you find a good deal, you go to your pool and see if they want to send
exactly. Yep. Right. Now, I will say there's a lot of operators that do this blind pool idea, and they'll say, here's our buy box. This is what we look for. We're raising money based on this buybacks, and based on our track record, we've proven that we can do this. And it's really advantageous for them to be able to do that, because they have a much stronger argument when they come to the closing table or to the acquisition space to say, we're sitting on $10 million. We can close this fast because we don't have to go out there and raise the capital. So from an operator standpoint, it makes a lot of sense. From a investor standpoint, I think you've got a lot more risk in that space before the assets are identified. And you hear the stories all the time where people invest in these funds and they're not able to find assets, so their dollars are just sitting idle. And personally, I don't want the dollar sitting idle.
So what is your favorite type of person to work with, and do you work with everybody?
Yeah, so my avatar is generally the high income W-2 sales guy. I think with anybody, just like you guys, just like yourself, the best avatar for any organization is a previous version of themselves. So I can talk the sales talk. I can talk about chasing guys all over the stack rank, and go to bed a hero, wake up a zero, of the ups and downs of sales craziness. The hunt, or the joy of the hunt, and the kill and all of that stuff. But really, outside of that, which I would say is the ideal, I'm really trying to educate and inspire that newer passive investor, somebody who's coming into the space that I wish I would have known somebody like me to kind of handhold through some opportunities, because you can make a lot of mistakes in this space. And once you place capital, like, it could be tied up for 5 to 7 years. So, if you're putting your last $25,000 in a deal and you don't know that it's illiquid, that can be a pretty precarious situation to put yourself and your family into. So, I want to educate the newer guy in this space and help them overcome some of those fears that everybody goes through when they first get started.
So for the newer investor, because I feel like a lot of people get into real estate investing and it's like kind of start like you did, like we did, single family home. Yeah. It's like, hey, I want to learn this thing. I want to do it myself. So what's kind of your pitch to somebody to go this route as opposed to doing this on their own and, buying their own house and trying to do the BRRRR method or whatever method they do?
Yeah. Well, I think it always comes down to what is it that they're trying to achieve. Are they looking for a hobby? Are they looking to start a business? Are they looking to get their hands dirty and swing a hammer and get, the tenants, toilets, and trash issues that we all know about, right? Because some people do. I do not want that anymore, but I had to try it before I knew that. If it's somebody who is a high income earner that really is just trying to get good returns, I think it can make a lot more sense for those folks to focus on what they do best, which is in their job, and then trust folks that can be good stewards of their dollars, that are highly skilled, experienced professionals that are going to probably do better with the capital than they would be doing on their own. So, ultimately, you've got to look at what they're trying to accomplish and then try to match that with the best strategy. And some people, it is like, you find folks that maybe they're not high income earning, but they want to get in the space. And I think flipping is a great way to do that. I think BRRRR models are a really great thing to do if you don't have the capital, because you can leverage hard money and use all these other things. But if you're making strong W-2 income, odds are your time's better spent doing what you do best, because you're going to get a better return on your time than you would, chasing down contractors and property managers and trying to find Section 8 renters and all of that stuff. So yeah, that's just my personal opinion, but I think the allure of the real estate investing and all the HGTV stuff that you see, people get excited about that and they think they're going to be another Chip and Joanna Gaines. And, the Chip and Joanna Gaines is just it's not really all that profitable to do that unless you're doing it at a very large scale as well. So anyways, yeah.
Yeah. So you said earlier that you're glad you went through the process of getting your first and your first few deals, even though it was such a struggle, because now you probably wouldn't be where you are now because of it. So that's something that, like, I guess to your point, like, you need to know exactly what you want to do. Like, if you want to build to something bigger, like what you're doing now, do you tell somebody that they need to do the first things that you did, the BRRRR, the struggle with the single family, the turnkey rentals, or do you tell them to partner with somebody who's done it before? What would be your advice to somebody who wants to start and they want to do bigger things?
Yeah, I think syndication model is the ideal place to start, whether you want to be active or passive. Most of my deals, you can actually invest for as little as $25,000. So quite often, very much less than going out there and buying single family anyways. And I encourage folks to spread their dollars across as many deals and operators and asset classes and business models that they can, just because you don't really know what you don't know until you get into the space. So, if you've got 100 grand, put it in 4 different deals with a couple different operators. And, after 6 months or so, you're going to see, or you're going to probably gravitate towards some asset class or some operator or some business model, and then just keep going deeper in that arena. But, there's so many different ways you can make money in real estate. I think it's less important what you choose to do. It's just simply that you make a decision to do something and go do it. And you can readjust at any point from there. So, I did turnkey to Burr to trying to buy multifamily on my own to passively investing. And now I'm bringing bigger checks through fund management, and who knows what the future is. But I would have never gotten here had I not, got excited and ran home and told my wife, hey, we're buying turnkeys in Kansas City. I don't think. So I don't think it matters so much. It's just make a decision and do something.
So $25,000, you said as little as $25,000. To a lot of people, $25,000 is a lot of money.
Yep.
But I assume that not everyone that you raise money from has $25,000 just sitting in the bank. Are there other ways that you can educate them on how they can invest their money with you? Because like I said, like $25,000 in the bank versus maybe some other retirement accounts or anything. So how do you pitch them on that if they don't have $25,000 in the bank?
Yeah, and let's be transparent. Like investing passively in mobile homes or even actively, it is not for everybody. I am a big advocate of having your financial house in order before you get into this space, because I see a lot of people that come into real estate investing thinking they're going to get rich quick, and then they starve their families out while they're chasing deals and doing that. So this is for it's for somebody who is financially stable, I believe, already, and who is starting to accumulate wealth and trying to grow that wealth steadily over time and not get rich quick is first and foremost. Now, most people don't, even if they are gathering wealth or growing wealth, they're not probably sitting on a ton of money in their bank accounts. Myself, when I first started investing passively, I leveraged an old 401k that I had from that first 10-year stint, and I moved those dollars into a self-directed IRA custodian. And most people don't even know that you can do that, but that was how I made my first investment. And it was kind of the training wheels way of passively investing. I didn't get any immediate income from it because it just goes back into the IRA, but it allowed me to kind of test my strategy and get my feet wet in this space without having to come technically out of pocket. It almost feels like monopoly money sitting out there if you can't touch it for 30 years anyway. So that was an easy way to get started. Excuse me. But yeah, there are different strategies where people use like life insurance policies. All kinds of different strategies, but it really just depends on where your assets and making that decision on the first one. And then you can adjust course from there.
I think I wanted to touch on the whole thing. Like if you don't have 25,000 in the bank, there's a lot of people that will have 25,000, 50,000, sometimes 100,000 in some sort of retirement account that can be accessed for these types of deals that they don't even realize.
Yeah, absolutely.
Yeah. So for your investors, what kind of returns are they looking at? And is it just like percentage on the money they invest, or are there tax advantages they can get by investing through you?
Yeah, so the syndication space is very similar benefits that you can get from investing directly in real estate. The general pro forma, I joke quite often, I think there was a seminar sometime where they created a deck that said double your money in 5 years, and we'll give you 3 to 5% cash on cash throughout the hold, because everybody's deck looks almost exactly the same. But generally that is the pro forma. Operators are not buying assets unless they can provide those type of returns. So you're going to see generally, cash flows year one, we're seeing 5 or 6, sometimes even 7% year one cash on cash year one, with usually a steady growth in that as they stabilize the asset, depending on what type of lending or what type of leverage that they're using on the asset. And then on the back end, when they sell, we're seeing equity multiples around 2x. So, if you get $5,000 per year throughout the first 5 years of the hold, when they sell it, you get your $100,000 back and another 75 to 2x your capital throughout the whole period.
All right. So we said we were going to talk about mobile home parks a little bit.
Yeah.
So what are you seeing? I guess this is not exactly a segue into that, but what are you seeing as your favorite asset class? Ours is definitely mobile home parks, but what is your favorite type to invest in?
Yeah. So I've invested in mobile home, and I'm more and more interested in the mobile home space. I don't think it's as sexy as some of the other stuff that you see out there. So
Of
I
course.
can tell you, I had my very first passive investment was with a very large operator that we all know from a large podcast that we've probably all listened to. Um, and I put 100 grand from that IRA into his mobile home fund. And, I've gotten very good returns out of it up until the pause distributions that occurred in the last 6 months or so. Um, I think affordable housing as a whole is the space where I want to be, whether that be multi-tenant mobile home, whether that be um, affordable development that I'm looking at here in Phoenix, or if it's value add with some type of tax abatement strategy that is catered towards affordable housing. But I think there is there is a huge need for affordable housing, and it's a huge issue in the United States. And I think we need more operators to focus on that space to drive change and to drive opportunity for entrepreneurs like yourself and I to be able to allow entrepreneurs to make money in the space while also providing something that's so needed for the population.
Yeah, I think that space, like for us with mobile home parks and like, you know, any of the affordable housing, I know my dad's an older guy, older generation, and he's very like skeptical about everything. And every time he's hearing a lot of stuff about what's going on with, like, there's a recession coming and like what's going on in the economy and all this stuff. And I mean, a lot of it sounds pretty reasonable, like it could be happening, and some of it is happening. Um, but so as we're like getting new parks under contract, he's always kind of, "Hey, you sure everything's okay? Like you're going to keep going with this?" But kind of to your point, it's like there's this huge need for that type of housing right now, and it's like as like not to say it's like fully recession proof, but I feel like it is somewhat because you're dealing with these people that are getting some sort of government assistance already,
Yeah.
and like the housing prices are so low. So I mean that's one of the reasons I like the space, in addition to the fact that we buy mostly tenant owned parks with mostly tenant owned homes, so we're
Yeah.
not doing a lot of like maintenance and that kind of stuff. Um so you're kind of looking at everything when you're looking at these funds, you apartments, mobile home parks, whatever.
Yeah. No, I mean, the 70% of my portfolio is multifamily value add. So that is really the core of my investment thesis is I think affordable, clean, safe housing in good markets is the best place to put those dollars. Then, all of the economic indicators show that this housing demand will only continue to increase over time when we look at new starts and construction. The gap between renting and owning is bigger than it's ever been in the history of the United States. Like all things point to affordable housing options being the best path. So I love what you guys are doing. I think we need more attention there because there's not a whole lot of new permits that are allowing more mobile home parks to come into the market. So the ones that exist, if you can transition those ones into beautiful, thriving communities for people with lower income to live in, um, there's no place to go beyond that. So when things get tough, people aren't moving into A class; they're stepping down, and they're not moving from mobile homes anywhere because they own the houses and it costs too much to move them. So I think it's a great place to be personally. And transparently, I am talking with a number of different operators to try to find an opportunity to partner with them because I want to put those type of opportunities in front of my investors as well. So
Well, so now with what you're doing, running this fund, are you also investing in these deals yourself, or like essentially how are you making your money now that you're operating in the way you are?
yeah, so there are. So the answer is yes and no. So I do not invest in every deal, and it's not because I like more deals than others. I will not put a deal in front of my investors unless I would invest in them, just simply from a cash flow standpoint. I don't have the capital to put into the markets because I have everything. I'm in 24 LP positions today, so everything is out there except for the dollars that we have just set on the side for liquidity. So the way I make money today is, one, I've got those 24 LP positions that a good portion of those are paying distributions. And then I also, with fund management, there is income that's made in fund management. And generally, I will actually, or the fund will hold back an acquisition fee of all the dollars that we raise. And then as my investors get the returns that we promise, we make the majority of our dollars on the back end when we sell or refinance those assets. So cash flow is a little tighter on the front end until we get a lot of these to start going full cycle. But once you do, you're really building a machine that kicks off very impressive returns on the back end. So.
I mean, I've done a lot more of the property management side of things within our business, my wife and I.
Okay.
And yeah, hearing that, it's like, yeah, once you're kind of waiting for that first deal to go full cycle, but then if you got 24, I'm sure each year one's kicking off and you're just like, yeah, this is great. Like,
yeah,
no more phone calls, no more toilets, none of this stuff. So
exactly,
it's definitely appealing.
The machine that is your money working for you. That's
everybody's
dream.
Exactly.
Truly passive, actually.
Yeah. I tell folks too, like everybody's got to have a way to make money. And then you got to have a way to invest your money. So if you can marry those two together, I think it's the best of both worlds, really.
Yeah.
All right. So we're going to move to our final segment. We call this one the Final Five. We ask everybody these same questions.
Love it.
So let me just find it.
Normally, podcasters will share those questions with you beforehand, but this is real time now.
Gotcha.
Yeah, we were kind of wondering about that. We're like, are we supposed to share these? But then we kind of like, not necessarily catching people off guard, but it's like, it gets you thinking, and
you don't get canned responses that they've been practicing for days, right? Yeah.
Yeah.
Although as somebody
on the spot, genuine.
As somebody who has been a guest on a couple other podcasts, I would appreciate getting these early on. So I apologize.
well, when you guys are on my podcast net, you will have the questions in advance, but I might throw in one just because of this. So
okay.
Yeah. There you go. You're fully we'll allow.
Yeah.
You
can surprise us with anything.
Perfect.
Oh man. Okay. All right. Number one is what's a top financial resource that you found, whether book, podcast, where do you go to educate yourself in finances?
Yeah, good question. So I'm watching more now, like economics related speakers and experts. So there's a guy named Jay Parsons that I watch that talks about the economy trends and those type of things. I really like. There's a podcast called Old Capital, which is really good. Multifamily Texas. I think they're lenders and they have brokers on there all the time. So it's really kind of behind the scenes talk tracks on what's going on in the marketplace. Let's see here. There is a guy who does a quarterly report who's an economist. I can't remember what university he's a part of, but his name is Peter Linneman. And they do the Linneman report once a quarter. And he's on the Walker, I think it's called Walker Webcast podcast. Quarterly, which is always a great listen. And even some of the bigger operators, like Andrew Cushman, who's another GoBundance guy, he puts out some content that is just fantastic. So you and I, Joshua, we've got access to some channels in GoBundance where we see some very high level economic discussions going on about trends that we're seeing in the marketplace. So my advice to folks is just get around the smartest people you can find and listen to what they're saying and doing. And don't just assume because they're saying and doing it, though, that it's the right thing to do. Be sure to bring your mind and your questioning mindset to it to make sure that it makes sense.
Yeah. And I feel like there's always two really smart people that are very passionate about what they believe, and they're not always going to align. A lot of times they'll disagree with each other. So just
absolutely,
I follow a lot of people and then pick out which one you like the best.
Yeah. Well, actually,
so what advice? Oh, go ahead.
Sorry to go down that one. But what I like more than that is when you get those two people that are passionate and they're able to have the conversation and then they can even question their own belief just to confirm whether it is or it's not. And when you find the guys who are just adamant, like this is the answer no matter what, and everybody else is wrong, like I run the other direction from those guys because usually they're blind. I heard somebody say the other day, when I make big mistakes, I had no idea it was coming. It's always a surprise to me, and yeah, I think it's important to be aware of that.
Yeah. So number 2, what advice would you give your younger self?
Get started sooner. Don't sit on the sidelines. Jump in and make a decision and do something. That's it. I sat on the sidelines for 10 plus years. And I found real estate investing when I was 45. And by the time I was hitting 50, I was financially free. Yeah. Had I started in my late 20s, early 30s, who knows how far I would have been.
So to all of our listeners, that's a very common theme. So if you guys are not very quickly going to get into real estate or some sort of investing, you guys just need to. Can't
Nobody ever says, I wish
enough.
I would have waited 5 years to get started. Ever. Nobody ever says
100%,
that, right?
100%. Yeah, it's so powerful. And even if your first year doesn't go amazing, just the learning from the first year, and the progression it's a very steep learning curve.
Yep.
All right. So third question is, what are your big goals for this year? What does the next 12 months look like for you?
Yeah, so I'm about to launch 2 new partnerships. One is with a debt fund, DLP, which is a lender and an operator in the multifamily affordable housing space. Really excited to be doing that. It's a 90-day liquid investment that's giving 8 to 10% returns with monthly distributions. So it's a great answer to the folks that have money sitting in high yield savings accounts. I'm also going to be doing some infill development here in Phoenix with some GoBundance partners as well that I'm just super excited about. I love the idea of seeing a 1 or 3 acre piece of land somewhere and being able to grab that and throw up some townhomes or condos or multifamily or single, whatever it is. I just think it's a great use of the space. And the overall goal, we've helped about 100 investors up to this point, and the goal is to help 1,000 passive investors make their first or next passive investment. So that's the overarching goal, to help people decrease their dependence on their W-2.
All right. So number 4, if you were to tell people to do one thing right now, what would that one thing be?
I would say invest in themselves. I have been a big advocate of personal and professional development for years and years and years. Like literally, when I was just getting out of college, I bounced a check for a Tony Robbins CD set. And, I just love that stuff. And I think, if you continue to grow your mind and you grow your skills, those are returns that'll pay off for years and years to come. So.
All right. Final question is, what's the biggest financial mistake that you've made? And what'd you learn from it? And are you going to make it again? No,
well, am I going to make it again? Hopefully not. Biggest financial mistake. Goodness. I think it just comes back to that not starting soon enough. I spent money like water for a lot of years and thought because I was making big income that I was wealthy. And when you shut off the spigot, you find out real quickly how unwealthy you are when you don't have passive income. So, as they say, if you can't make your money work for you while you're sleeping, then you'll be working the rest of your life. So I did not take that advice soon enough, would be probably my biggest financial mistake.
Yeah, I think it's a probably different set of issues, but you hear about these professional athletes that make these multi-million-dollar contracts, and then all of a sudden they're like out of it. And it's like, you just kind of think to yourself, like, how could you ever run out of that money? But yeah, if you're not investing it and you're just spending it as fast as it's coming in, eventually it runs out.
Yeah.
I think I might be making this up on the spot, but I think I heard someone say it's like
probably
the average the average professional athlete that's a multi-million-dollar while they're working as the athlete is bankrupt in 5 years. That's just a crazy stat.
I agree. I'm going to quote you now, Joshua, on that stat when I share it.
That sounds good.
Yeah, but going back to the mindset stuff, T. Harv Eckert has this analogy that he uses. He talks about a financial thermostat. So we all have this thermostat of where we are financially. And if we go above it, we will automatically bring ourselves back down. And if we fall below it, we'll find a way to get back up. So it's really trying to figure out a way to increase our temperature on that thermostat. And we do that by reading books, listening to podcasts, hanging out with guys like you, and just hanging around people that are doing bigger things. That's the only way we can ever change permanently, is to continue to expand our minds. So,
yeah. And I'll speak on that for just a few seconds here. So when I joined GoBundance a little bit more than a year ago, it's crazy how that temperature thermostat, whatever, raises, because like over a year ago, like I used to think that $100,000 was just an enormous amount of money. And then I'm hanging out with all these millionaires and they're like talking about 100 grand, like it's just something they have in their pocket at all times.
Yeah.
So just hanging out with people that are doing really big things is going to change your perspective.
Yep. And that's true not only from a financial standpoint, but from a health standpoint, to a spiritual standpoint, to a relationship standpoint. Living life big in all areas of your life is more important than just finances. So
100%.
Yeah. So before we let everybody know where they can find you, I would just ask that if you quote, just make sure you quote Josh and not the podcast.
I will. Not a legally binding quote. Okay.
No, I'm just kidding. Josh is throwing stuff out here all the time, so we gotta be careful with what we're putting out.
Yeah, throwing up on the wall, something's going to stick, right? So,
exactly.
Yeah,
that's right.
Yeah. So where can people find you and reach out and see what you're doing?
Yeah, my website is impactequity.net. I spend a lot of time on LinkedIn under Randy Smith, and Instagram. Randy Smith Investor on Instagram. But LinkedIn and my website are the best ways.
That's good. Well, thanks for coming on today. Look forward to launching this one. Everybody can learn a ton from this one.
Awesome. Thanks so much for having me, guys. This was a lot of fun.
Thank you.